Over the last 24 hours, global foreign exchange markets experienced severe whiplash. On April 30th, the US dollar to Japanese yen exchange rate plummeted violently from the upper 160s down to the mid-155 level. The catalyst for this drop was a massive live stealth intervention executed by Japanese authorities, directly selling dollars to buy yen. The message from Tokyo is explicit. The Ministry of Finance has officially drawn its line in the sand to defend the currency. Navigating this volatility requires separating temporary government liquidity shocks from the underlying macroeconomic realities that dictate long-term valuations. We need to deconstruct the exact mechanics of this tactical intervention, define the rigid macroeconomic floor holding the yen down, and build a defensive treasury playbook for the second quarter. Insulating balance sheets in this environment requires corporate allocators to completely separate political market manipulation from structural mathematics. Heading into the late Asian session on April 30th, the exchange rate had breached the critical 160 yen level, its highest point since July 2024. This breach triggered aggressive verbal escalation. Finance Minister Katayama warned that the time for decisive measures was approaching, followed by Vice Minister Mimura issuing what he called his final warning. Decisive market action that followed exploited a highly specific window. Japanese markets were closed for the Golden Week holidays, creating a severe liquidity vacuum. This timeline plots the dollar to yen exchange rate on April 30th, mapping the exact hours of the ministry's intervention. Notice the sharpest phase of the yen's appreciation occurs in a highly compressed window, strictly between 7:20 p.m. and 8:30 p.m. Right in the middle of that plunge, at precisely 8 p.m., the Bank of England released its monetary policy announcement. Shortly after, at 9:15 p.m., the European Central Bank released its own policy decisions. This overlap with major European central banks was a deliberate tactical choice by Japan. By executing a massive live intervention exactly when global liquidity and trader attention were heavily focused on Frankfurt and London, Japanese authorities maximized the shock and awe impact of their capital deployment. The upcoming release of the Bank of Japan's current accounts data will definitively confirm the physical magnitude of the capital deployed during this window. The timing reveals the true nature of the event. It was a surgical strike, engineered to punish speculative short sellers, not a mechanism to cure the Japanese economy. Despite this aggressive show of force, direct currency interventions only manage volatility. They cannot resolve structural macroeconomic imbalances. Looking at this dashboard, the market now perceives the 160 to 162 yen range as a definitive political ceiling, heavily capping further near-term dollar upside. But the left panel reveals the first structural headwind preventing long-term yen recovery: the historically wide yield differential between U.S. Treasuries and Japanese government bonds. Even with the Bank of Japan signaling potential rate hikes, those adjustments cannot overcome the gravity of the Federal Reserve maintaining a higher-for-longer stance. The rule of international capital flows remains intact. Money will structurally and relentlessly flow toward the higher yield. The second overarching factor weighing down the currency is Japan's severe terms of trade crisis. Japan is a net energy importer. With global crude oil prices remaining persistently high due to supply blockades, the country is exposed. High imported energy costs translate directly into continuous structural yen selling pressure from domestic businesses needing to acquire dollars to pay for fuel. Returning to our range box, combining the yield chasm with the energy deficit establishes a hard macroeconomic floor at 155 yen. Based on the precedents of 2024, expect the exchange rate to stabilize in the 155 to 158 range in the near term, with persistent upward pressure testing that 160 ceiling as the third quarter approaches. The exchange rate is firmly trapped, capped at 160 by intense government willpower, but floored at 155 by the unforgiving mathematics of global energy and bond markets. For corporate treasurers and multinational operators, central bank macroeconomics must now translate into a defensive microeconomic posture. Operating within this artificially capped, highly volatile environment makes standard financial modeling dangerous. Static forward contracts carry severe risks right now due to the threat of sudden multi-yen intraday swings, driven by further ministry intervention. This risk matrix shows the linear, inflexible exposure of a standard static forward. If the government forces a 5 yen drop in an afternoon, the opportunity cost locked into this contract is massive. Treasurers must pivot to options-based strategies. By utilizing a zero-cost collar, as shown by this non-linear payoff line, you cap your downside risk on yen receivables while retaining flexibility if the Bank of Japan induces another sudden appreciation. The second strategy involved accelerating capital expenditure for operations inside Japan. At the current 155 to 158 exchange rate range, operating costs within the country are heavily discounted in dollar terms. Multinationals should immediately accelerate planned yen-denominated real estate acquisitions, local hiring, and broader expansion plans. This bar chart compares total localized operating costs priced in US dollars. If the macro thesis holds that the yen will struggle to sustainably break below 150, deploying capital at a 158 rate remains highly efficient. Financial modelers must recalibrate supply chain pricing and rigorously stress test margins against a 155 to 158 baseline for the remainder of 2026. Adopting dynamic options and accelerating local spending are the mathematical methods required to insulate a corporate balance sheet from this sovereign tug-of-war. Currency interventions manage temporary volatility. They do not cure structural imbalances. Looking at our final range box, the boundaries for this second quarter are set: a political ceiling established by the Ministry of Finance, and a macroeconomic floor dictated by energy deficits and bond yields. Corporate treasurers must abandon financial models built on the assumption that the yen will smoothly strengthen back to historical norms. Survival in this environment demands strategic agility, a complete rejection of static hedging, and a clear-eyed capitalization on discounted operational costs. True financial insulation requires taking these macroeconomic government actions and actively translating them into microeconomic balance sheet defenses.